cement, and the demand is on the rise if one goes by Shree Cement and UltraTech results. Volume growth healthy for both companies as well. What's disconcerting though is the lack of pricing power, which probably has been elusive for some time now. The commentary also doesn't sound as optimistic as one would have hoped for. Should cement players be happy with just volume growth? And what are the implications of this kind of a growth on the fortunes of the cement stocks? To talk about this in greater detail is the Associate Director at Kotak Institutional Equities, Murtuza Arsiwalla. Murtuza, so good having you. Thank you so much for taking the time out and speaking to us at Bloomberg Quint. This is Neeraj here. Good morning. What did you make of the commentary from UltraTech, and what implications does it have for the rest of the pack?
I think more than the result itself, it was the management commentary which sort of spooked investors, if one were to go by the results. Essentially, there was expectation, and having looked at the sector for a long while now, we haven't seen a period where you've not had price increases for such a long sort of dry spell, so as to speak. And management commentary, opening commentary from the management was on the lines of the expectation on price increase was far more muted. And this is coming in January, which is sort of, the start of the new construction season. Typically, Jan to March, April is when you see a lot more construction activity and a lot more pricing movement. And that's sort of what spooked the investors, to my mind. What it really leads to is essentially the expectations from earnings, because there's a very high leverage to pricing as far as cement sector goes. So those expectations being toned down, further consensus estimates being brought down, and that's essentially what you saw in terms of the stock movements.
Okay. Do you see this as an issue that is going to linger until the print from the companies shows otherwise? Because hitherto, a lot of people have been hoping for return of some pricing power, some bit of capacity utilization levels moving up. Now, would you take a call on what happens to the cement companies' fortunes after they show it in the data, in the reported data?
Not necessarily. I mean, if you look at cement, as a sector, if you look at the stocks, essentially, typically on a monthly basis, you have sort of price revisions, which have been elusive, which have been muted. In some cases, we've seen that price increases have been taken, but rolled back. Definitely a more confident statement would come in when you see it in the print data, but there is enough, sort of channel checks, dealer checks, which on a more sort of frequent basis, let you know as to how the pricing is behaving. We've not seen very aggressive price movements even in January. We'll have to see what sort of February holds for us. But I think investors tend to look at it on a monthly basis. And I think we would look forward to what's happening in the next 2 or 3 months. If we have a continued dry spell in terms of lack of price increases for another 2 or 3 months, you'd probably start looking at, late summer, starting monsoon, and then you'd really push back for another year. And, the earnings which have been downgraded over the years will essentially add another year to that tally.
Okay, interesting. No, the reason I asked this question was that, so UltraTech, for example, they expect about 7 to 8% YOY demand growth in FY20 after a subdued Q1 FY20 as well. Maybe till the time the elections are out of the way and then the monsoons, the numbers might not pick up. What is your base case for this? And therefore, my question is, even if managements were to paint or experts were to paint a better demand scenario for the second half or the last 3 quarters of FY20, would somebody go out and believe that or wait for some early signs before taking a call?
I think so. What's been happening is with the cement sector, you've had a spate of bad news over the last 9-12 months, where you've had constant cost increases, you had no price increases. Volume was your sort of sole savior. So volumes have been rather healthy. Probably going into the election sort of period, you may expect some sort of subdued activity on the volume front, but overall volumes have been healthy. Now, the good part is on the cost front, you have seen things improving. Crude's coming off, pet coke, imported coal, all of them have begun to ease, and that delta will come in. All said and done, if you were to see some price increase come through, there will be an element of cheer essentially on the stocks. Having said that, the bigger problem with the sector has not been the lack of demand, but it's been the continued sort of oversupply situation, which we do not really see very dramatically changing. So, while you've been at the receiving end of things, with the lack of price increases, a price increase would definitely help bring some respectability to earnings. Costs are improving. The utilization rates are not going to dramatically change. So you will be sort of range bound in that sense, where you may have some price increases, but there's not going to be a tearaway sort of quarter that's coming ahead of you in that sense.
So Murtuza, what's the call on the companies? I mean, as we speak, Ultratech is down another 3% as well. No doubt, as you alluded to, the commentary not looking all that great, and which is why this cut. So 1.5% Thursday, 7.5% Friday, 3.5% today. A lot of people would start believing that valuations have started looking attractive. I was reading a report which spoke about how the return ratios for some of the companies over the last 10 years have come off so much, then maybe a lower EV per ton, EV EBITDA is a new normal. What is your sense of how you would value these companies? And therefore, if we apply those parameters, do the companies look fairly valued, marginally overvalued, or undervalued?
So, we've been cautious for a while now on the sector because of the oversupply situation. We continue to maintain that stance. I think what's just helped is that the management commentary now sort of runs in parallel to what we've been saying for a while in terms of sort of weaker earnings trajectory for cement companies. That call still stays. So we're still fairly cautious on the sector. Yes, it's looking less pricey, let me put it that way, but still a long way to go before we turn constructive.
This is for the pack at large or for Ultratech? And if it's for the pack at large, what stands out? I mean, as a
for
good...
the pack at large,
for the pack at large.
So for the pack at large, but we've been more sort of, we've had a larger sell call on, let's say, in Ultratech and Shree Cement, because the valuations there were far more steep. We have been constructive on some of the mid-cap names, the JK Lakshmi, even Dalmia, for instance, because there the valuations are less demanding. I mean, cement's a sector where, if you've had 3 months of good price increases, the entire commentary on the street will change very, very dramatically. Having said that, like I said, the base case demand-supply dynamics are not supportive still. But we would selectively look at names where valuations are attractive. Having said that, when we say attractive, we're looking at mid-cap stocks which are more 6-7 times EV EBITDA. Even in Ultratech, even after this 10% correction, still trades at close to about 12 times EV EBITDA on FY 2021. But that's better off compared to where they used to be, but still not attractive enough for us to turn constructive.
So attractive is what? 9 times, 8 times EV EBITDA for the space at large?
Keeping your margin of safety, yes. See, it's ultimately a commodities sector, and earnings can be fairly turned fairly sharply.
Murtuza, one final question of sorts. I think a lot of reports that have come out over the last 12 months have spoken about how, I mean, I'm giving an example, you would obviously know about it, but giving you an example, Ambuja Cement, for example, look at what it is trading at versus what the replacement cost would be for such an asset, and therefore it's trading in and around the replacement cost levels. So that makes these companies a good investment bet, and therefore that argument can be extended to some of the other mid caps as well, which have picked up capacity, albeit with a bit of debt added to their balance sheets. Is that a legitimate argument to make while choosing a stock, or you would kind of shun that argument completely and purely look at EV EBITDA and the commentary of a management while taking a call?
No, I wouldn't shun that argument completely, because you need to appreciate, I mean, while I'm looking at an EV EBITDA, if I had a 20 rupee price increase turning into next month, what looks like a 12-time EV EBITDA could very well be an 8-time EV EBITDA. So you want to take a combination approach as opposed to, looking at just one multiple in isolation. The replacement cost argument does hold good. Having said that, let me sort of extend that argument to you. Yes, let's say a stock is trading at replacement value, But if you look at the return ratios, which you yourself talked about, early in the session, the return ratios are sub sort of cost of capital. So maybe they should be trading at replacement cost for some of these names if they're not able to consistently generate above cost of capital. In fact, they should probably be trading at a discount. That may be an extreme argument to make, because the same reason that I argued about, how earnings can be very volatile. Likewise, for the return ratios, they could change fairly dramatically. But trading below replacement cost is a good starting point in terms of evaluating stocks, but not the only way that one wants to look at it.